So in this fourth lesson in this series on value investing, we're going to be looking at valuation, how to value companies fairly quickly, and how to determine if something's going to be a good investment, assuming that it's a wonderful company. So first we determine if it's a wonderful company. Then we can look at, is it a good price? So first we ask, is it a wonderful company? If you're not sure how to do that, watch the last lesson. Then we try and determine if it's a good price. Theoretically, a business is worth the present value of its future cash flows, but in modern value investing, we have better approaches than using a discounted cash flow spreadsheet or some sort of formula or stuff like that. We have better ways of doing it, which I'm going to show you in this video. We're going to be using Meta as our example in this. We're going to be doing a rough valuation of Meta to see if it's a good price. So assuming you've done your diligence and research and looked at Meta and it's met your criteria of what a wonderful company is, we have to determine if it's at a good price. The way that we do that in modern value investing is we look to see what the rate of return is on Meta as an investment. Okay, so we're looking to calculate what the rate of return is on investing in Meta. The way that we do that is we're going to use three different models that triangulate on one another to determine if it's a good buy. We're looking for rates of return of 20% or above. 20% or above, ideally 25% or above. So let's get started. The first method that we're going to be using to value Meta is the earnings per share projection. Earnings per share projection. So what we're going to be trying to do is we're going to try and determine what Meta's earnings per share is going to be in 10 years' time. Let's do it together. So let's go to Y charts here. First, we need the trailing 12 months earnings per share. We find that number, it's $10.53. So if we were going to paint here, we can write down it's $10.53. That is Meta's trailing 12 months earnings per share. Now what we need to find is a growth rate for Meta. What is an appropriate rate of growth that we can anticipate Meta over the next 10 years is able to deliver? I personally like to use revenue growth. So if we look at the 10-year revenue growth of Meta, it doesn't have a lot of really good numbers for us. The most recent number is 41. That's way too high in my opinion. So we can look at the 5-year revenue growth. So over the last 5 years, Meta's been able to grow its revenues at about 34% per year. Personally, I do not like to use any sort of growth rate above 20%. So 20% for me is my absolute maximum. And that allows me to be more conservative in my estimates. So I will never assume that Meta can grow its earnings per share at more than 20% per year, or any company for that matter. Going back to paint here, we can see that over the last 12 months, Meta's earnings per share have been $10.53. Assuming it's able to grow them out at 20% per year, we then can figure out in 10 years' time what Meta's approximate earnings per share are going to be. So let's do that together. We take the $10.53 in earnings per share over the last 12 months, and we multiply that by 20% for 10 years. Let's do it together. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we're assuming that in 10 years' time, using this formula, growing Meta's earnings per share out conservatively at 20% per year, we're saying in 10 years' time, Meta can be earning $65.20. $65.20 per share. This is what we assume Meta will be earning in 10 years' time. We need to now multiply this by a fair multiple, which is usually equal to the growth rate. So if we multiply this future earnings per share by 20, we get a price in 10 years' time for Meta of $1,320. Sorry, $1,304. Doesn't really matter, this is just basically spare change, but $1,304 is our future price for Meta. $1,304. We compare that to the current price, so we can see Meta is currently trading at $132 per share. Let's go back to paint, which means that this is a 10-bagger, meaning we can expect the price of Meta to go up 10 times over the next 10 years or so. Now I'm going to use my phone. On my phone, I have a calculator here, which is a compounded annual growth rate calculator. And if we assume right now we're paying $132 for Meta, and in 10 years time it'll be $1,304 or roughly over a 10-year period of time, that would give us a compounded annual growth rate of about 26%. And remember, we're looking for investments where a rate of return is going to be at least 20% per year. But we're not done there. We have to run our next model, which is our return on equity model. So let's do that here. We can do it in orange, return on equity projection. In order to do this, we have to project out Meta's equity base over the next 10 years. So let's do that together. So we look at the book value of Meta. So book value, we can use the quarterly figure. Meta's book value is 124 billion. So let's go back to Paint. Actually, we'll use the per share figure since we use per share figures for the other numbers. So Meta's book value per share was about $47 per share. So let's go here to Paint. And we have to now grow this out 10 years forward using what Meta's been able to grow its book value at. And we can use the 5-year growth rate. Meta's grown its book value at about 16% per year. So let's grow this number at 16%. So we can do this. So 47 times 1.16. We'll do this for 10 years. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This gives us a future equity base of Meta of $207 per share in terms of its book value. So remember, Meta currently has a book value per share of $47. It's been able to grow it out at about 16% per year, meaning its future equity per share is $207. Its return on equity has been, over the last 5 years, averaged 25%, meaning we can assume that Meta will be able to deliver 25% on this number in terms of its earnings per share. So 207 times 25% will give us a future earnings per share of $51.83. $51.83. Okay, so let's review this again. Meta currently has a book value per share of $47 per share. It's been able to grow this number at about 16% per year, meaning in 10 years' time, Meta's book value per share will be about $207 per share. It returns on average 25% on this book value, meaning in 10 years' time we can assume it'll give us $51.83 in terms of its earnings per share. We now multiply this by the same multiple we used here of 20 to give us a future target price. 51.83 times 20 will give us $1,037 per share. Look at that. Look how well these two triangulate one another. Using with two different methods, we came within basically some spare change, like a couple of percentage points. So we take this number here and we add it to 1304. We average them out, even though there's really no point in doing any sort of math for this. But we get about $1,170. This means that in 10 years' time, we can assume that Meta's future price will be roughly $1,170. If we go back to, if we use this calculator here and we use this number instead, 1,170, over a 10-year period of time, that gives us an annualized rate of return of about 24%. 24% using this number here. In addition to this method, we have our third and final method that's going to verify this centralized percentage figure. We have now our return on capital model. Basically, what we're going to be doing is looking at Meta's return on invested capital divided by its weighted average cost of capital. Meta's weighted average cost of capital is about 9%, and its return on invested capital over the last 5 years is about 25%. Let's go back to Paint. 25 divided by 9 gives us a 2.8 as our multiplier. Meaning if we divide the return on invested capital by the cost of capital, we get 2.8 as our multiplier. We multiply this by Meta's net income, which is 28.8 billion. $28.8 times 2.8 will give us a certain number. So we take this number here. We can do 2.8 times 28.8. That'll give us 80.64 billion. We divide this 80.64 billion by Meta's enterprise value. Meta's enterprise value is 328 billion. So let's go back to Paint. So let's divide these together. 80.64 divided by 328 gives us a return of 24.6%. Look how beautifully these numbers triangulate on one another. Look at this. Meaning if we were to invest in Meta today, we would anticipate at least a 24 or about a 24% annualized rate of return. 24 to 25% is what this is saying. Look how well these numbers triangulate on one another. You cannot get this by doing a discounted cash flow analysis using an Excel spreadsheet. That is the power of this style of, of calculating intrinsic value and rate of return. So we're looking at the rate of return. So once we determine if it's a wonderful company, now we have to run this model to see if we're getting a good rate of return. And we are. We're getting about a 24-25% rate of return. We're looking for at least a 20% rate of return. In addition to this number here, let's just say our rate of return is going to be 24%. We'll take 24%. We also have to add to it the dividend yield and share buyback yield. Meta, we call it the net common payout yield, which is the dividend yield plus the share buyback yield. Meta has been doing about 3% on average over the last 5 years or so. So about 3%. So they've been buying back and paying out in dividends. They don't pay dividends, but they've been buying back about 3% of their shares. So if we were to add to this number 3%, we would get about a 27% annualized rate of return. Remember, as modern value investors, we're looking for at least a 20% rate of return. Meta meets that criteria. If, through your own analysis, you determine that it's a wonderful company, by watching the last video and seeing what determines what makes something a wonderful company, then you should go ahead and make the investment, but only if it meets your own personal criteria. So in this video, we're looking at what is a good price. The way that we determine if something is a good price is we run these three models in modern value investing: our earnings per share projection model, our return on equity projection model, and our return on capital projection model. Using our earnings per share projection model, we determined that a future price for Meta will be about $1,304 per share in 10 years' time. That would give us a 26% rate of return. Using our return on equity projection model, we projected out another future price. Combining these two gave us a 24% rate of return on this centralized future price figure compared to the current price. And then a return on capital model acted as a check on this figure by basically taking Meta's return on invested capital divided by its cost of capital, giving us a multiplier, multiplying its current net income to this multiplier, dividing that number by its enterprise value would give us a rate of return, and then adding Meta's share buybacks and dividend yields. It doesn't have a dividend, but it has share buybacks. It's been doing share buybacks. Will give us a rate of return. We're looking for this number to be at least 20%. And it's substantially above that. So I hope you found that video informative. If you have any questions, please ask in the comments down below. Thanks.